A very happy day to all of you and welcome to my YouTube channel. I'm your learning partner Sushila Hariharan. In this module, we're going to take a look at what are the ratios that are mentioned in a fund fact sheet. A few days ago, I had already uploaded a document on the fund fact sheet, and the video clearly explains how early mutual fund investors, people who are joining the industry, people who are looking to start investing in mutual funds, interns who have got their first jobs are all looking to initiate an investment portfolio for the long term in mutual funds. They must read the fund fact sheet. As already explained, the fund fact sheet is a very detailed document which comprises the portfolio management strategies, the asset allocation, as well as numericals like NAVs and key ratios about the particular mutual fund. The fund fact sheet, in fact, is a wealth of information about the fund manager, the assets under management, as well as it comprises great details about how the fund is going to operate as per the information memorandum and as per the investment objective. In this video, we're going to take a look at what are the ratios that have to be mentioned. So SEBI has already mandated that every fund in their fund fact sheet must declare some very important investing ratios. These ratios give an idea to the investor about how the fund is allocating its funds amongst various asset categories. This information in the video is very useful, especially for early investors into mutual funds who don't exactly have a very clear picture about what kind of mutual funds that they should invest in. A fund fact sheet is a monthly update on the mutual funds portfolio and the asset allocation. As you perhaps already know, every mutual fund is operated by the asset management company, and there are different funds for different purposes, depending upon the risk taking capacity of the investor. Funds give a variety of options to the investors to start investing in the very robust mutual fund industry. But there has to be some bit of transparency in terms of information sharing by the fund house with the investors. That information sharing is done by the fund house on a monthly basis as mandated by SEBI. So SEBI is very clear that you have to share information about how you are allocating your assets under management, AUM, to different asset categories. And investors can then understand from the asset allocation whether the investments are in highly risky assets or moderate risky assets. This monthly fund fact sheet gives an idea to the investor, not just the existing investor, but even to the potential investor, as to how the fund manager is thinking. Sometimes there is significant growth in the equity markets. Sometimes there are war-like events. Sometimes there are pandemic-like events. These events create a little bit of um, turbulence in the equity asset allocation strategies. So, how do investors override this turbulence? How can investors understand what the fund manager is doing? What is the fund manager thinking? How is he allocating the money? What is he seeing that we are not seeing? All this information gets down to the fund fact sheet. And therefore, it is very important for investors to read the fund fact sheet to understand how the asset allocation is taking place in different months of the year. All right. And even more important, to rather than just reading a fund fact sheet at a point of time, it's very important to read the fund fact sheet over a point of time. So if you look at the fund fact sheets of the months of January and February, there has been a small increase in the allocation towards cash because of the significant economic uncertainty that is surrounding multiple issues like Fed tapering, the war between Russia and Ukraine, etc., fund managers have they not reduced their investments significantly. That is a good point. They have stayed invested in many of the asset classes, but their allocation towards cash in the funds has slightly increased compared to this allocation, let's say in January 2021 or even over December 2021. So the fund fact sheet gives a very clear information, and this information is really important for potential investors. What are the key ratios that are mentioned in a fund fact sheet? Let's take a look at that. The first ratio that is mentioned in any fund fact sheet is the beta of the fund. The second that is mentioned is the Sharpe ratio. And the third that is mentioned is the R squared ratio. So apart from all the information that is mentioned on a particular fund fact sheet, the ratios give a clear indicator to the investor as to the asset allocation of the fund. How does it do so? If you want to know more information, I'm sharing the the website link of some of the fund fact sheets in the comments below. Take a look at how fund fact sheets are read. If you look at these three ratios, they give an idea to the investor as to how much money is allocated by the fund manager in different categories of assets. This helps the investor know, depending upon his or her risk profile, into what mutual fund they should be investing in. The fourth one is the expense ratio. The first one is the beta ratio. The beta is a measure of volatility of mutual fund portfolio to the benchmark. Every mutual fund has to be benchmarked to an underlying index in order to be in a position to evaluate what was the performance of the mutual fund portfolio compared to what? Compared to the benchmark. So here we have a large number of investors who are already directly investing in assets under the benchmark. So is the mutual fund performing as well as the benchmark? Is it outperforming the benchmark? Is it underperforming the benchmark? All these evaluation of the performance parameters comes under the ratio of beta. If the beta is less than 1, okay, this means that the mutual fund portfolio has a volatility that is less volatile than the benchmark. So for example, what happens if the beta is, let's say, 0.50? Okay, if the beta is 0.50 and the benchmark falls 100 points, the mutual fund portfolio will fall 50 points. All right. If the beta is less than 1 and the benchmark increases by 100 points, then the mutual fund portfolio also increases by 100 points. This is the meaning of beta less than 1. So over here, if you are comfortable with investing only in assets which are less volatile in terms of prices, then you would look out for an investment in a mutual fund which has a beta that is less than 1. What happens if the beta is greater than 1? If the beta is greater than 1, it means that the mutual fund portfolio is more volatile than the benchmark. If the markets are good and there is a very strong bull run, beta being greater than 1 is very helpful to the investor. It is very richly rewarding to the investor. Let's say the beta is 1.25. If there is a crazy bull run in the market and the benchmark goes up by 100 points, the mutual fund portfolio will increase by 125 points. The investor is very happy with this portfolio. But that is just the rosy picture. If you look at the dirty picture, in this case, if the benchmark falls by 100 points And if the beta of the mutual fund portfolio is 1.25, then the mutual fund portfolio falls by 125 points. Okay, so the investor then has to decide as to what is the level of volatility that they are comfortable with. And asset prices, as you've seen in the last months of 2021 and the early months of 2022, have been extremely volatile. Volatility creates significant amount of profits or losses, much more than normal. And that is something that is very important for the investor to understand. In many of the index funds, you would expect that the beta is exactly equal to 1 because the fund is structured according to the benchmark. So if the benchmark is increased by 100 points, the mutual fund portfolio also increases by the same proportion and vice versa. So the volatility is perfectly volatile with respect to the benchmark. This is the interpretation of beta ratio. The next is the Sharpe ratio. The Sharpe ratio is the risk adjusted return of mutual fund. So beta only shows the volatility of the mutual fund performance vis-a-vis the benchmark, but the Sharpe ratio shows you the risk-free return from the portfolio that is given to the investor. Over here, you subtract the risk-free return from the portfolio return and you arrive at a Sharpe ratio. This measures the excess risk on every additional unit risk that is taken. This measure will explain and to the investor, to the potential investor, that if you're going to take an additional risk, what is the additional return you're likely to get? That number comes up in the Sharpe ratio. What does a Sharpe ratio of 1.25 imply? If the Sharpe ratio is 1.25, it implies that every time the risk factor increases by 1, the return that is expected from the investor is 1.25. So this Sharpe ratio is a very important number to be shared to the investors, because then the investors can understand what is the risk reward ratio. So if you look at the previous beta ratio that shows the volatility, over here the Sharpe ratio shows the risk adjusted return. Okay, so you now know whether the mutual fund is investing in high risk, moderate risk, or low risk assets, and what is the allocation between these three ranges of assets. A risk aggressive investor will invest in a mutual fund which has got a higher Sharpe ratio compared to a risk averse investor who is more comfortable investing in a mutual fund that has got a lesser or a lower Sharpe ratio. The third one is the R squared ratio. The R squared ratio is used to measure performance of a mutual fund vis-a-vis the benchmark. So look at the first one. The beta showed the volatility vis-a-vis the benchmark. The Sharpe ratio showed the return compared to the risk-free return. In R squared ratio, we are using the performance of the mutual fund vis-a-vis the benchmark. R squared is denominated as the term R2, okay, is a percentage between 1 to 100%. That means the more the R squared ratio is tilted towards 100%, the performance of the mutual fund is as good as the benchmark performance. If R2, R squared, is 90%, then it is as good as the benchmark performance. If R squared is 45%, then the performance of the mutual fund is not as good as the benchmark. Thank you so much for listening into the video. If you like the content, please share with your friends. I request you to please post your queries on the comments below. If you need any additional information, especially those who are in investment banking ops, please do write in and ask for comments, ask for content in the comment section. Thank you so much.